One part of fundamental analysis is the process of using the financial statements of companies in order to inform investor decision making. But if you think about that for not very long, you are quickly going to realize that there is an embedded assumption in that process, and that is that the accounting numbers are in fact relevant to the capital markets. Now, that may seem obvious and unquestionable, and in fact, the academic finance literature has a multi-decade history of testing accounting and market data and finding evidence that this relationship does indeed exist. However, these are purely empirical findings, and they stand in pretty stark contrast with the theoretical frameworks. What do I mean by that? Well, the capital asset pricing model has no need for a company's balance sheet or income statement. Its variables are the risk-free rate, equity beta, and the whole market return. If you're going to use the dividend discount model, you can value shares without any need for any specialized accounting numbers or ratios. And if you think about using the free cash flow models, yes, you often derive your free cash flow numbers from accounting data, but those are merely an intermediate step towards the ultimate objective of calculating, and I'm going to put some emphasis here in saying this, in cash flows. It's really all about the present value of future cash flows. So this residual income model that we are going to be talking about in this video is a bit of an oddity. It is not widely used, although it certainly has a place in valuation practice. But it is definitely not one of the top 3 or even top 4 or perhaps even the top 5 valuation methods in a finance professional's toolbox, as it were. Why then the interest in this somewhat obscure residual income model? Well, the key thing is that it shows that the theoretical determinants of equity intrinsic value are two things. And those two things are in the financial statements. They are the book value of owner's equity and earnings. In fact, we are, in other words, using two accounting numbers in this model, which are respectively the bottom lines of the balance sheet and the income statement. The residual income model is derived from the argument that the accounting rules get the capital costs of a company wrong because of the odd way in which the costs of debt and equity are treated. Interest expense is recognized in the income statement, but the cost of equity is nowhere near that income statement. So residual income fixes this by specifying that this number, the so-called residual income, is accounting earnings minus a charge for equity. Let's turn attention to how this model is derived. And we are going to start with the discounted dividend model, or DDM. By starting with the famous and well-known dividend discount model equation, we demonstrate the validity of the residual income model equation by showing that it is in fact, under some fairly realistic assumptions, the equivalent of the DDM. Let's do this step by step. Step 1, as previously mentioned, is the DDM equation. Next, we apply the so-called clean surplus assumption. Under this assumption, the book value of a company's equity at the end of a particular accounting period is equal to the book value of equity at the beginning of the period plus earnings for that period minus dividends paid during that period. We then rearrange that equation and substitute for D subscript T in the DDM equation. The next step is to separate that into two terms. In step 4, we add 0 to the first term in order to allow ourselves to do something useful in the next step. Step 5, we factor out that B subscript T minus 1 term selectively from the first term in the way shown on the screen. In step 6, we separate the first term into two, leaving the last one untouched, and we now have 3 separate terms on the right-hand side of the equation. In step 7, we separate out the t equals 1 case from the first term. This we do because it allows us, when we put t equals 1 into this expression, to transform that first term into something very interesting that we're going to see in the next step. By separating out that t equals 1 case, we must just pay attention to the way in which that transforms the second term of our equation. And we note there that the summation operator, after the separation of the t equals 1 case, now is indexed from t equals 2. And that makes a lot of sense. The other two terms on the right-hand side of the equation are not touched at this point. Now in step 8, we can see the purpose of that separation of the t equals 1 case. And that is because the first term resolves to B subscript 0, which is the book value or the accounting number for the company's equity at valuation date T0. We then just write out the remaining terms, which are unchanged from step 7, and we'll turn attention to those next. In step 9, we have our B0 first term, and then to restore our indexing of the summation operator of that second term to starting at t equals 1, we factor out 1 over 1 plus r, and that results in a summation operator indexed as before from 1 to infinity, with b subscript t times 1 plus r in the numerator and the usual denominator of 1 plus r raised to the exponent of t. Once again, the final terms on the right-hand side are not touched at this point. We will get back to those later. In step 10, we are now able to tidy up the second term by multiplying the 1 over 1 plus r back into the summation operator, leaving us with a second term, which is b subscript t over 1 plus r to the exponent of t. And we have our familiar second two terms on the right-hand side. Now we have in step 11 a situation in which the summation operator is applied to 3 different terms, all of which have exactly the same denominator. So we can validly, applying the standard rules of algebra, combine those terms as we have done in step 11. And we notice that we have some cancellation happening. B subscript t is cancelled out, and we are left in step 12 with the residual income model equation, which tells us that the intrinsic value of a company's equity equals the book value of its equity plus that summation operator, which is in fact the present value of its residual income discounted at the required rate of return on equity. If you have any questions about any of those algebraic steps that I carried out there, let me know in the comment section and I'll do my best to answer them. There's a lot going on under the lid of this very interesting but somewhat obscure model. If you have any other issues about when an analyst might be interested in using this particular model, for example, let me know as well, and I'll do my best to get back to you. And that is it. Thanks very much for watching to this point of the video, and I will see you in the next one.